I don't see much change in the fundamentals. I don't see the economic value of the companies changing, with a couple exceptions. Obviously, Ant Financial was predicated. A lot of the revenue came from credit. Okay, that piece has been knocked down. The ed tech companies knocked down. You could argue that the larger companies, the Alibabas, the JDs, are going to not be as dominant as they were, as the government sort of gives more space for smaller companies to come up, which appears to be their intention. That's actually good for investors. But I don't see much change in the economic fundamentals of these companies. Now, how the market perceives them, especially in the US, I don't know. I live in Asia. I'm probably out of the loop on all that stuff.
On EdTech, I'll just let people know, OGIG has little to zero holding in EdTech since the early days. And the other thing you mentioned, Jeff, if the government actually wants those smaller and mid-sized giants to succeed, OGIG's an interesting way to do it as well, because what we've seen in the past is the rules have done a really interesting job of identifying those companies early, because the revenue growth rates are stronger for many of these mid-sized giants, stronger than the revenue growth rate of the mega giants. Kevin, what are your thoughts on how China is going to do in the next 6 to 12 months from a policy point of view and from a tech stock performance point of view?
I think in 6 months we'll have forgotten about all this debate. I don't really think it's real. I don't think there is a tech crackdown in China that's going to affect growth of these companies. And Jeff made a great point earlier. When you own a basket of U.S. domestic equities that are large cap stocks, there is no way you're not exposed to China, either through manufacturing or supply chain or direct sales of product or service. I don't care if you're Boeing or Tesla or a small $100 million private domestic company is in some way sourcing goods and services out of China. So you already have exposure to that economy, and that's a good thing because it is growing faster than our domestic, and it should be, given what they're doing, and will continue to for probably 20 more years. And at some point, it will become the biggest economy on earth, and you want to be an investor in that. That probably happen in the next 20 years. So to me, I don't say you can't ignore it, because you can see what it did to prices of large cap tech stocks. But again, the only thing I concern myself with is not equity price in any one day. It's, are they still growing? And the answer to that is yes. And so I'm happy to own them.
You said something that people should think about. It's quite likely to become the world's largest economy because they got so many people, even if per capita they're not making as much as Americans. So how do you end up as an investor or a professional and advisor owning nothing in China when it's likely to be the world's largest?
Yeah, you would be irresponsible to do that. You would definitely probably underperform the indices over a longer period of time. And I don't know what reason you would have to do that. I mean, even Europe, Europe is a very interesting geography now. It was disliked for 7 years, and now it's performing again because there's at least 50 large cap companies in Switzerland, Europe, and London, England, that any investor should own. Nestle, Roche, and others are interesting, and they have half their sales outside of Europe and Asia and in the US. So I think of it now as policy and political rhetoric get headlines, but in the long run, it's growth and free cash flow that reward investors, and so that's what you have to keep in mind.